Welcome back. You're watching Stockwatch with me, Zinati Kuma, and joining me to take your stock-related questions tonight are Pierre Verster from Protea Capital Management and Devin from the Robey Group. Do send your questions on email at stockwatch@bdtv.co.za or via SMS on 41392 or on X using the hashtag Stockwatch. We've had, I think, a couple of sessions with the JSE reaching record highs. I guess still at those levels because it's pulled back slightly, 0.02%. JP, starting with you, how impressive has this been?
I would say 0. Something the same is not very impressive, Zinati. Sorry, but yeah, it's an average movement.
Yeah.
You might even say it's a below average movement, but at least it's a movement that's upwards.
Yeah.
And a lot of people prefer upward movements because generally when you own shares and they go up in price, then you've got more money, you've got greater wealth. And who doesn't like that, Zinati? As a short seller, sometimes I like it when markets go down and stocks go down. Then I have more money. And sometimes when they go up, I have less money. So I'm less impressed by the market going up than most long-only investors might be.
Capitalizing on every opportunity and every cycle. Devin, what have you made of the kind of gains that we've seen on the JSE and even actually on the Rand, even though we have had a slight pullback on the local currency today?
Yeah, I mean, it's kind of, we took a breather after a really good run, bar the craziness a week and a half ago. I mean, you just got to cast your mind back to the volatility that just exploded on markets for a number of reasons. We had the VIX up over 100% in a couple sessions, and then crashing back down as though it never happened. And we've continued from there. So what it's meant is that the JSE has hit all-time highs this week. I think that's probably driven by a couple factors. I think you're slowly getting confidence start to come back into our market. I think, generally valuations have been off a depressed base. The expectation that rates here are also going to be coming down. And no load shedding has, an economic and a feel-good factor to it. So I think kind of a combination of all of those have really helped us. But today wasn't something to write home about.
All right. Well, let's get to the questions. And a counter that hasn't really participated in the positive momentum that we have seen on the JSE in the last few days is Thungela, of course, yesterday releasing results. The question is, all things being equal, i.e. the coal price staying more or less where it is now, would the panel regard Thungela still good enough to be part of one's portfolio? I guess the key question there is the coal price. JP.
Yes, so depending on which coal price you're looking at, there's a Richards Bay coal price, there's a Newcastle in Australia coal price, and then the coal exporters like Thungela would contract out the sales in advance. So they'll take a discount to that price if they can lock in certain prices. And you saw that with the results yesterday as well, where it was quite a significant discount, where the average price was over $100, but they could only call it just under $90 as their realized price. So if the coal price stays where it is in dollar terms, you would hope they have less contracts, so their realized price would be slightly higher. That would be good for them.
Okay.
But then on the other hand, you've had the Rand strengthen, which would be bad for their exports if they sell the coal in dollar terms. It's less rands if the Rand strengthens. So, the fact that they only paid a small dividend, 2 Rand a share, shows you that the business is cash generative in the good times, but there's still environmental liabilities. There's a lot of capex. Taking coal out of the ground is an abrasive process. You are depreciating your yellow metal. You need to buy more machines to dig the coal out of the ground. So I'm not a big fan of coal mining shares. I think with the benefit of hindsight, we can even go as far as saying they were clearly in a bubble because of the Ukrainian invasion. And for about 12 months, you had these wonderful coal prices, and everyone with coal made a lot of money. But are we ever going to go back to those types of coal prices again? I don't think so. Europe has got natural gas importation infrastructure now. So I think it was a bubble, and therefore, no, I wouldn't have exposure to a lot of coal in my portfolio.
Well, I mean, I don't know if it's the CEOs also playing it down, because they're saying, as you mentioned, JP, it was a bubble. They're calling it the big cycle that we had, a watershed moment, and that the coal cycle has normalized. Would that be what you're calling it at this point, Devin?
Yeah, I think that's probably accurate. I think, we came from, this kind of peak territory, and it does seem over the last 18 months that it is starting to find a bit of a level. So yes, I think that is right. So I think those bumper profits and dividends that shareholders got a few years ago are probably the thing of the past. Mm-hmm. I do think, they are doing some good things. They're buying back shares. There's still a fair dividend here. So I think there are some good things to it. But, carrying on from JP's point, when you're a company that extracts effectively one commodity out of the ground, your future is inextricably linked to the price of that commodity, and that's really come down significantly of late.
I mean, obviously we know the headwinds, but also you talk about some of the good things that they are doing. At this point, would you say, Devin, that it is good enough to be part of one's portfolio, or are you just like JP that no, not at this point?
Yeah, I think there's better places to hunt. I think that there's, if the coal price ticks up, you'll get some nice operational leverage come through. But that's not a given, and so as a result, there's a lot of a big variable into this, and the exchange rate feeds into that, exactly as JP said. So that's a pass for me.
All right. What about Murray and Roberts? The viewer says I'm up about 130% on Murray and Roberts in the last year, and it's become the largest individual holding in my portfolio. Should I take some profits or see how far it goes? It's only about 1% of the overall portfolio, though, which is well balanced. Should the viewer take profits or maybe just hold on a little bit? I don't know. Would this be one that you are looking at this point, JP?
So I think, firstly, well done to the viewer buying Murray and Roberts in the depths of when it was looking so bad. They lost control of their Australian operation. Who knew if they were going to see the light of day still, if the South African bankers were going to support them. And they got through that. And since then, the shares are up over 100%. So well done to the viewer. Look, rubbish getting less rubbish can be very powerful in terms of a share price rising from very, very cheap levels.
Yeah.
But once it has doubled, how much juice is there left in the lemon? Because for me, construction is a lemon. It's not a great industry. And WBHO and Rawbex are the two companies that have made some money from this sector, and specializing more in road construction almost than anything else. Yeah, even for WBHO, their forays into other countries like Australia and the UK haven't been very successful. So no. You asked me about coal. I don't want exposure to coal. Now you've asked me about construction. I don't want exposure to construction.
So
I'm really sounding very bearish here.
You want nothing.
But sorry, I don't want either of these, and I would sell those Murray and Roberts after 130%.
And I mean, yeah, you're right. Absolutely well done to the viewer. But now, getting to this level, Devin, would you sit in the money that you've made, or would you kind of let go a little bit? What would your view be on this?
Look, I'm not sure exactly when the viewer went in, but over the last year, pretty much hasn't been any higher. So there's definitely an opportunity to take money off the table here. I think the Murray's kind of portfolio is, it's not one that appeals to me. You've got a lot of the mining operations, you've got some in North America, Australia, and the like. They provide some engineering in there. I think that's okay. It's fairly low margin business. OptiPower is somewhat interesting, but fairly small within their life. So not enough in it for me. My sense, taking profit, there's probably more compelling opportunities elsewhere.
What about Aveng? Because it came out with numbers today, swinging from a loss to a profit, also talking about a splitting of its core operations there. I know that in the past, viewers have asked us if Aveng could be a potential 10-bagger. JP, what would you say to that?
Okay, so Zanati, I don't like coal mining, I don't like construction, and I don't like contract mining.
Yes.
Which is what Moormans does. So it's
Yeah.
going to be another pass from me. And almost the only way in which you get a 10 bagger is if there's a 10 for 1 share consolidation, which is effectively what they did. But yes, the share price has also risen, if you go back 2 or 3 years, from levels where people thought Avengers was going to go bust. And when you buy shares in a company in which everyone thinks it's going to go bust and it doesn't go bust, you can do quite well. But once it hasn't gone bust, then I still think you should pack it up and head off for the next opportunity. And just have a look at ArcelorMittal to see what can happen. I mean, it went into the depths, call it 5 years ago, bounced, and it still looked cheap when it was almost at 10 Rand a share. Now we're back below 2 Rand a share. It shows you that a bad business can have its day in the sun, but over the long term, you want to trade it, you want to be in and out. You don't want to stick with it for the long term.
I mean, Devin, they're still in the game, and they want to be even still continue to be in the game by implementing the strategic review. Yeah, would you not say that it's one worth giving a chance?
Look, kudos to the team. This looked very dire a while back, and it looks like they've managed to avoid disaster. But you know, I think the hard work still lies ahead. They've now really got to build this thing up to scale from the glory days many years ago. And I just think the environment is incredibly difficult. The landscape has shifted. You've got new competitors and entrants coming in. And yeah, I don't think there's easy money ahead. I think it's really going to be hard yards, and not something I'm jumping into.
All right. Let's go to China, Devin. Alibaba. Can you please give me a view on Alibaba? Is it a buy at these current levels? I think they released results, was it this week or last week?
It was on Thursday, I think.
Yes.
Yeah, so small miss on the earnings estimates from what I could see. And yeah, I mean, I think the company is struggling a little bit with executing on the e-commerce side, but it does look like their cloud operations are starting to pick up some quite nice momentum there. That looks good. I will say, as I've said on the show before, that I am cautiously bullish on China as an investment destination, and I guess Alibaba definitely falls squarely within that. I say wait until the end of the show for more details on it.
Okay. This is one that has been seen as very, very cheap. Is this one worth chewing on, JP?
We do have some Alibaba in our Protea funds and a few other Chinese shares as well. We're also cautiously bullish, as Devin has put it, on China. So I agree with that. The issue with Alibaba specifically is it was by far and away the biggest e-commerce player in China, which means from that point it could only lose market share. And unfortunately, it got a bit complacent and it has lost market share. So JD.com has taken some market share, but the other big one is Pinduoduo, which internationally we know the equivalent is Temu, which is a platform that directly links the producer to the end consumer. That has been taking market share. So I would say Pinduoduo is our preferred Chinese e-commerce retailer, but we do own some Alibaba, both for the retail business, which is very cheap, but also for the cloud business and AI and a bunch of other things, because they have diversified. And we're hopeful that the management team have shaken things up. They'll regain the focus. They aren't complacent anymore. They've seen how they've lost market share. And again, it's one of those where the valuation implies they're going to keep on losing market share. And as long as that is not the case, you can make some money with Alibaba, we believe.
All right. Well, let's go to a counter where investors have made quite a lot of money, and that is Shoprite. Could you ask the panel whether Shoprite is a good buy at these levels? Yeah, I guess on the other side of the spectrum, Devin, one that is not seen as cheap.
Yes, that's exactly right. And I mean, pretty much at all-time highs for the share. You know, it's had a really, really strong run of late, and they've taken market share from a number of competitors, most notably Pick n Pay. They've managed to grow net margins in a really constrained consumer environment. You know, a lot of us have experienced the efficiency of 60/60 and the other innovations that they've also rolled out. So yeah, doing really well. What I would say though, if you kind of look longer term, the domestic environment has really been hostile for these kind of SA Inc. retail type shares. I mean, over I think it was a 10-year period I was looking, it's barely kept track with inflation in terms of the share price growth. So, you're now buying it at a high point. I think there is some risk in that. It is, probably you could argue it probably earns its valuation where it is, but my advice would be, wait for weakness and buy into it. I don't think necessarily that all the tailwinds we've experienced over the last few days, necessarily persist indefinitely. The road ahead is probably a little bumpy, and so will give you better opportunities.
At this point, around 300, just over 300, JP, where would be a comfortable level for you to maybe dip into Shoprite? Maybe not put all your money in it, but if we do see a little bit of pressure on the stock?
Oh, that is a very difficult one to answer because I do believe the valuation is full. I agree with Devin. The problem you have is sometimes very good quality companies are persistently expensive. And the share price will effectively stay expensive, but it will track the earnings growth.
Yeah.
So it will still do well as long as the earnings growth is strong. And Shoprite is showing decent earnings growth into low double digits. So as long as that is the case, it could stay expensive for a long while. So if I tell you 250 Rand, or let's say I'm being cheeky and I say 200 Rand, I might wait a long time. It might be 7-8 years before it gets to 250 Rand. Or by that time, 250 Rand is so ridiculous. And if I only bought at 300 Rand, by that time, maybe the shares are 600 Rand, and I'll be crying that I missed out at 300 Rand. So that is the difficult one with high quality companies. So what I then normally do is I say, just buy a little bit. Don't have regrets. Avoid regret. Buy a high quality company, even if the valuation is full, but don't buy too much. And then if you bought a little bit, for me, psychologically, I'm going to track that stock. I'm going to track that company.
Yeah.
And if the share price then does drop, you're going to notice, and then you can increase your holding.
All right. I hear you on that. Let's talk about Absa. Why is Absa trading below their NAV? Can this bank's NAV narrow in the second half of this year? Devin?
Good, great question. I think there are some concerns around Absa at the moment. I think we've had the sixth CEO in as many years step down, and I think they've really struggled in that top office for continuity there. I think what happens then is that the strategy, these longer term strategies that these executives are tasked with implementing, keeps on getting derailed, and almost you can draw it back to since the Barclays demerger happened. They've really struggled to implement a high level strategy. So I think that is part of it. I think also that loan book is of lesser quality. I think the return on invested capital and the return on equity compared to some of the other peers in the market is substandard. And so as a result, I think there's a lot of questions about the quality of the franchise. I mean, if you look at Standard Bank and their African operations, they're far superior, in my opinion, to what Absa has there. So they got their work cut out for them. I think, you have to stabilize the ship with, good leadership that can execute on strategy, and then from there start to work through the business. And yeah, the jury's out on, when that'll happen or even if.
Yeah. Do you think, JP, that investors should maybe or could use that underperformance by Absa to kind of get into the stock, since it is cheaper than its peers?
So it's almost the flip side of the coin to my answer regarding the Shoprite question. In the case of a high quality company that beats its competitors generally, I say you can buy a little bit at a full price.
Yeah.
In the case of the company that gets beaten by its competitors consistently and might look cheap, I would say watch out in terms of buying too much. Also, just buy a little bit, because what the price is implying is it's saying that the ROE will not be sustainably above the cost of equity over the long term. That's why it's trading below book value. So because of that dynamic, one would hope and expect that the ROEs will stay above the cost of equity. At the moment, it's very, very slight. It's almost the same.
Yeah.
And if they do get that right, then it is cheap and the share price will follow and you could do well. But they are getting beaten by their competitors consistently. So yes, you can buy some, it's an opportunity, but I wouldn't buy too much because it is not the winner in the sector.
All right. Just sticking with you, JP, there's a question here for you. Do you hedge your gold shorts in any way, perhaps long physical gold?
We have done that because over the long term, the gold price does better than the price of gold mining shares. Although in the short term, you can have the gold mining shares do a lot better or a lot worse than the actual gold price. So yes, we have done that. But my preference when it comes to the gold shares, instead of hedging it through a long position in gold, is to just have very small shorts in gold because of that very volatile share price that gold mining shares show you. I mean, a lot of the gold mines, Harmony has doubled in the last year, while the other two have been more or less flat, as far as I remember. These moves can be big. So I would say if you're going to short gold mines, which a lot of people would just say, no, it's too volatile, I'm not going to do that. We do that to some extent, but keep the shorts very small. So we have a very diversified small book, and the gold miners are a very small portion of that.
Yeah, all right. Devin, I want to come to you with copper. Your outlook on copper and view on Orion Metals. I don't know how closely you look at Orion Metals, but maybe you can just mention your outlook on copper there.
Yeah, sure. I mean, Orion, not one I follow closely, but copper definitely. I mean, I think the demand for that metal is truly in a sweet spot. Green metal being used in so many applications for alternative energy, and you've seen how aspirational it is to own copper assets. When we had the whole BHP, Anglo's potential mergers there for the Anglo copper assets, I should say, that really was showing how people are looking to get hold of those at pretty high valuations. So there's an expectation in there for increased and sustained demand for quite a while. I tend to think that could very well play out. So yeah, bullish on the metal, but to my earlier point with coal, don't try to get the exposure necessarily through a single play. We're quite comfortable going through a diversified miner, getting that along with other basket of commodities.
All right, gents, we're getting to your stock picks for today. Devin, I actually want to start off with you because you said you would fill in the blanks for us as we're talking about Alibaba and China.
Yes. So China, in my view, is becoming an increasingly compelling investment case. I think there's a number of reasons for it. One, the sentiment has just been rock bottom for a while now. And as a result, valuations are incredibly cheap, almost universally across the board. What that means is it limits your downside as an investor. You've already fallen quite a bit. Chinese equities are also really decoupling from a lot of the US equities, other developed market equities, and even increasingly now against other emerging markets. So you've got very low correlation and nice diversification benefits there. And then it looks like recently Beijing's going to enter into another stimulus cycle. They're cutting various reference rates and that type of thing. So my preferred exposure there, although it is the sharp end of the stick, is to go for the Crane Shares China Internet ETF, code KWEB. And what that does is give you a basket of incredible Chinese tech companies. We've spoken about Alibaba, JP holds it. It's got Baidu in there, it's got Tencent, and particularly Tencent, Alibaba, and JD actually have all looked pretty decent with results coming out. So we think it's a great way to get exposure to what we think is an underappreciated part of the market.
All right. JP, what is your stock pick for today?
I'm picking a South African small cap. After the elections, there's much more interest in South African small caps. So a lot of shares that have been very cheap for quite a while might get some renewed interest. And one of those shares is Mustec. It's a computer hardware distributor. They import, assemble, and then sell computer hardware. A lot of people needed to buy new laptops and PCs when they started working from home the first time in 2020. So there was a big expenditure on computer equipment, but then that meant in 2022, 2023, there was a lack of spend because everyone still had their new PCs. So I expect that trend to reverse, and hopefully 2025 will be another year of decent expenditure on computer hardware. And then the founder tragically passed away, David Kahn, roughly 2 years ago. And there's been some movement on the shareholder register, some big blocks of shares changing hands. which shows that maybe without the founder around, people might be looking at Mustec because it is so cheap. And it might be an M&A target. So between a company that has improved fundamentals and could be a target and is very cheap to start with decent cash generation, Mustec is my stock pick tonight.
All right. Thanks so much for your time, Jeds. Really appreciate it. That is all for tonight's Stock Watch. Thanks to my guest, Pierre Verster from Protea Capital Management and Devin from the Rebay Group. That is, up next, the close. Stay watching.